The Australian Financial Review.
Hello, ho, ho! I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. He's long golden frankincense, but short myrrh. It's Anthony McDonald. How are you, Anthony?
Great, James, but unfortunately not quite the wise man.
Fantastic. Well, this week we're bringing 2024 home to roost with our highly anticipated Annual Chook Awards. We'll get some stock picks and views on the market from a fund manager who helps oversee nearly $8 billion in Australian shares, and we'll ask why America's version of the RBA has spooked markets. Well, Anthony, this is going to be an epic episode. I'm hopeful we can break the hour mark. We've got lots of great stuff to get through. But I want to start on Thursday when we saw a bit of drama on the floor of the ANZ Annual General Meeting with a big protest vote against the bank's pay report and outgoing CEO Shane Elliott forced to forfeit a $3 million bonus package. Now, you've been all over the discontent behind the scenes here. What's going on?
Well, I think the AGM just showed that the shareholder discontent is real, despite what the board thinks. We've talked about it a lot in the past 3 months, James. There's a lot going on at ANZ. There's this bond trading scandal. Johnny Shapiro's been all over it, our colleague. I mean, APRA's got concerns about its non-financial risk management. There's the upcoming CEO change. Basically questions about ANZ's risk culture. We saw at the AGM about 40% of the shareholders voted against the remuneration report. I mean, that's a chunky protest vote. Enough to put the board on notice, if it wasn't already, that there's serious investor concerns here. Now, I would argue that the protest vote is particularly strong given ANZ's share register. There's a lot of passive investors on there that would have followed the board's recommendation on this one and one of the proxy advisors' recommendations. So it's basically, it should serve as a wake-up call and say, look, ANZ board, this is real. Deal with it properly. Otherwise, you're just going to get left behind. So, I mean, I do feel for Shane Elliott in a way, leaving his $3 million bonus behind. But, I mean, if you read the room, that's just not the year for it, is it?
No.
You know?
No, well said. I'm just thinking ahead, though. The list of challenges for this bank is growing, isn't it? Like, you've already got, navigating the fragile Australian economy and the competitive banking market. That's one thing, right? Mm-hmm. You've also got to bed down a new CEO from Nuno Matos, who's coming from HSBC, never done any banking in Australia, steep learning curve ahead. That's another issue. Then you've got all these strategic imperatives inside ANZ. They're trying to bed down integrate the acquisition of the Suncorp division that they bought for $4 billion. They're trying to do this ANZ Plus tech platform. And then the chairman, Paul O'Sullivan's got to go around and sort of placate investors, get them back on side. It's a full slate, isn't it?
It sure is. And James, this should have been the year. This should have been the AGM where they're out there celebrating the Suncorp Bank acquisition, talking up their growth in Queensland ahead of the Olympics up there, big growth market, big potential for them. But instead, it's just derailed by all this other stuff.
Yeah, well put.
Now, James, also on Thursday morning, you were up early for your regular check-in with Jerome Powell, the chairman of America's central bank, the Federal Reserve. Now, James, Powell delivered investors a Christmas rate cut, but Wall Street plunged 3%. So what's going on? Yeah,
this was a weird one. I mean, in a way, it's not entirely clear why the Fed needed to cut rates again on Thursday morning, because the economy in the US is going well. Their projections have growth accelerating, unemployment coming down, inflation going up. So that's not exactly any reason to cut. But look, Jerome Powell wants to give a bit more support to the economy. He's now cut rates by a total of 1% in the back half of 2024. Fair enough. Now, you'd think investors would go, yeah, that sounds good. Rates are down 1%. Stocks are already at record highs. There's a little bit more fuel on the fire. Away we go. But the problem was with what's called the Fed's dot plots, which is basically a chart of all the Fed members' projections of where they think interest rates are going. Now, a few months ago, the Fed was those dot plots suggested that the Fed would cut rates 4 times in 2025. On Thursday morning, the dot plots suggested that the Fed will only cut rates twice in 2025.
Yeah, right.
So investors are like, hang on, we've priced in 4 rate cuts. Now we're only going to get 2. This is a disaster. Stocks off 3% in the space of 2 hours. Total overreaction. I mean, geez, the market's just dumb sometimes. Wall Street is sitting on a 25% gain. It's had one of the great years, despite all the uncertainty in the world. It's the second 20% plus gain in 2 years, and still investors want more. Give us more, Jerome. Yeah. So I think Jerome Powell went out there thinking, I'm going to give investors a Christmas present. Instead, the investors think, here's a bit of coal in the stocking. And now the Santa rally, which often occurs in this last week of Christmas when trading's a bit thin, people are, trying to make their books, their portfolios look good towards the end of the year. The Santa rally might be off. I'm not counting Santa out yet because I think this was an emotional reaction. We might see a bounce back, but it's fascinating to me, Anthony, how sort of all in investors are on the good times, the growth story. Maybe a little bit of a reality check's not the worst thing heading into the new year, I reckon.
Yeah, totally. And I do wonder how much work goes into those dot plots, James. Like, we hear about them and they seem to move the market, but you do wonder how scientific they are. But what struck me listening to him as well was how well the economy is going over there, according to Jerome Powell. Unemployment, what was it, 4.2%, I think. It's good. Inflation in the 2s, good. There's been rate cuts. Yeah, the government was just turfed out for pretty comprehensively, and one of the issues was the economy.
Good point.
Because people aren't feeling that good about life. So what's it actually like, do you think? I mean, is the economy actually firing like Powell says, or is it battling because people don't feel like they're doing better?
Oh, it's a great question. I've actually been thinking about this. As we get to the end of the year, it's been you look at if you came down from Mars and you looked at the share markets in Australia and the US, you'd think, wow, that's nice. But does anyone really feel like it's been a good, fun year? I would say no. And it comes back to that thing that RBA Governor Michelle Bullock said, prices are 16% higher than they were before the pandemic. That takes adjustment. Powell said it on Thursday morning. Inflation is not going up, but prices have already risen, and that people are getting used to that. They don't like it. It grates. So, I mean, if I'm Anthony Albanese heading into the federal election next year, man, this shadow of inflation, and how it weighs on the mind of voters and investors, I'd be worried about that. But let's see. Maybe over the Christmas break, everyone's restored to a better headspace. I don't know.
Yeah, the costly Christmas break.
Yeah, exactly. All right, Anthony, it's time. We've scratched back through the columns. We've pecked all over the good stories of the year and found a few things to crow about. Yes, it's time for our annual Chook Awards, where we explore the good, the bad, and the ugly of Australian business in 2024. Anthony, it was an extraordinary year. We had rampant regulators, government-bashing businesses, CEOs chopped off at the knees, billion-dollar bids go bad, and an IPO that ruffled feathers but made its backers plenty of extra cash. I can't believe I'm doing this. We have 5 categories, and the only rule is that there's no walking on eggshells. Let's let the roosters out of the bag. First up, it's the award for excellence in business for a CEO or company that excelled in 2024. Anthony, you lead us off.
I'm going off the beaten track a bit here, James.
Ooh.
I'm going for Frank Calabria from Origin Energy.
Okay.
This is a business, it could have gone off the rails. Like, remember this time last year, the big story was Brookfield and EIG Partners trying to making a bid for the company. The board had been working on it for 18 months, went to a big shareholder vote, and it sensationally got voted down.
Yep.
At the time, the board got it plain wrong, and there were threats of spilling the board. There were 4 directors that were up for re-election, including the chairman, Scott Perkins, this year. People were getting in my ear that they'd all be voted off, that this was a failed transaction.
Had to go.
Exactly, had to go. They'd allowed Brookfield to muck around for too long on this bid. there was concerns that Origin's earnings had peaked, that management would have got distracted by the whole bid and the thing would go off track, would never have the cash flow to invest in renewable energy, to make its transition plans. It'd have to demerge APLNG or something like that.
Yeah.
Well, James, what ended up happening was this thing reported $1 billion profit in FY24. It's looking strong again for FY25. Its earnings per share was up there with the best it's ever been. There's a new dividend policy in June. It's got an extension at Araring, its big coal plant up here in Sydney. That's now pretty much underwritten by the government, so it can't be loss-making the next few years. It's bought a big wind farm development in New South Wales. It's approved big battery developments. It's Octopus Energy, its big venture capital bet. I mean, it's had them out there explaining the value in there. Those 4 directors, including the chairman, got re-elected with 95% plus takings. And Frank Calabria, the CEO, who was looking at a big payday under the private equity buyout, I mean, he's still there and he's kept it all together. So I think it's quite amazing. Australian Super is still the company's biggest shareholder with 16.5%.
Yep. Proved right.
They seem relatively happy. And then the whole thing about this Brookfield bid, it's all gone away. And if anything, it's only just underscored the value in having energy assets at a time when energy demand is going through the roof and the whole system's transitioning. So well done to Origin Energy and Frank Calabria in particular for keeping it together. What about you, James? Who's your Excellence in Business Award for?
Mine goes to Ryan Stokes, the CEO of Seven Group Holdings. I reckon he's one of the more thoughtful CEOs in the country. He's done a great job with this business. Conglomerates come in and out of fashion. This is an old school industrial conglomerate. They own big mining, heavy equipment business and Coates Hire. They've got an energy business. They own a big stake in Seven West Media, which is probably the weakest part. Well, definitely is the weakest part of the portfolio. But I like to sort of think of this, and it's a bet on Australia, this business, and it's been going pretty nicely. The stock's up 33% in the last 12 months. Of course, Stokes managed to pull off the privatisation of Boral, which has been a hugely successful turnaround engineered by Stokes and Vic Bansal, the chief executive at Boral. So I just think this is probably an award that has been coming for a few years. Stokes has very patiently turned the dials on this one, sort of all come together in the last 12 months. And, if you think about where this business goes next, if the big sectors in Australia, mining, infrastructure, construction, energy, if we think they're all going to go well, then Seven does well. So Seven Group needs to do well for the country to do well. And in the last 12 months, Stokes has really managed to turn the dials in a pretty impressive way.
Good one, James, and one of our business people of the year.
Yeah.
Next up, the opposite end of the spectrum, the Rooster Booster Award for the CEO company who delivered a 20-kilo pile of crap.
Easy winner here. Mineral Resources and their founder CEO, Chris Ellison. Stock's down now about 55% from its peak a few months ago after the Australian Financial Review revealed that he'd been involved in a tax avoidance scheme 10 years ago.
Yeah.
Bit of a thing you might have wanted your investors to know. And from there, the whole place just unravelled. We've heard now about all these related party transactions. We've heard about Mineral Resources staff working on Ellison's boat and properties. He's had his own Mineral Resources worker who's looked after his personal finances, sweetheart deals on rent for his daughter, property deal he was on the other side of. I mean, I just don't get it. This guy's a billionaire. He's done so well building this company. Why is he bothering with all this nickel and dime stuff that just doesn't make any sense to me? He's promised to stand down, but won't be standing down, leaving the company for 12 to 18 months. There's plenty of shareholders who want him to stick around, and there's plenty of people who think he will stick around. So this one's not done, but it's just a really good example of where an entrepreneur who's done fabulous things can get a case of hubris and it just unwinds for investors. Really painful. Anthony, who's yours?
Well, James, I mean, we said this last year. There's just too many to choose from, really. But sadly, I've got a carryover champion here.
Oh.
Same company as last year. And there's no one to pin it on this time because no one's been around longer than 3 minutes. It's in that much disarray. And that's Star Entertainment,
Yes.
James, the owner of the Star Sydney, Gold Coast and Brisbane. I mean, last year it nearly went broke twice and it didn't have control of its casinos. This year, it's still nearly going broke despite raising $1.5 billion last year. Still doesn't have control of its casinos.
Yep.
It's hanging on by a thread financially. It's had its executive ranks smashed. Its new chairman has a new chairman. Its company's pants were pulled down in its second inquiry in New South Wales, one that it didn't know anything about until the day it was announced and the day it started. The business is going backwards. This regulatory crackdown, the carded gaming and the provisions for people have to like register before they go in and gamble. It's been an absolute shocker for the business. It's smashing earnings. And did I mention it's seriously like 2 minutes from going broke again? So new CEO Steve McCann is out there running around trying to raise more money, but he's got a shocking story to tell. He's got a business going backwards where he's not even really properly in control of his casinos, and the whole thing's pretty much uninvestable as it is today. So it's just an absolute shocker.
Yeah, absolutely. And carryover champion is a good way of describing it. Anthony, our third award is the Rotten Egg Award for Stinkiest Deal. You're our M&A maestro here at the Chanticleer podcast. What's your nomination?
Well, this one never happened, James, but I think it's significant enough to talk about it anyway. And that's BHP going after Anglo American. It's a total head scratcher. They just stuffed it. I mean, the logic is there. Copper. They love copper. BHP, like Rio Tinto, makes bucket loads of money off iron ore. There's uncertainties about China and how much iron ore it's going to keep buying into the future. So they're diversifying further away from iron ore, getting into copper. Sure. Yep. Copper, demand for copper is going through the roof. We all get it. But to do this, it's gone after Anglo American, which is heavy on copper. It was an unloved target, turnaround story, get it while it's cheap, all makes sense. But it did it in the lead up to the South African election. And for a messy deal that would require South African government approvals to do that in the election
wasn't the time.
Just seems so harebrained. And you called it out as soon as they launched it, James. And sure enough, they continued to do it for the next 6 weeks or so, and they just pushed the proverbial uphill, unable to get any traction at all. They couldn't get any traction with the South African government. They couldn't get any traction with Anglo-American shareholders, despite the fact it was incredibly unloved at the time. I mean, I think it bid 3 or 4 times, including always against itself, no other bidder in sight, got no real board engagement. It pissed off its own institutional investors to the point where if this is not the stinkiest deal of the year, it's only because they pulled out, because shareholders didn't want it to happen. And this from a board and a management team that's been crowing about how conservative it is, how disciplined it is in its approach to using shareholder capital, trying to make up for M&A sins of the past. I mean, James, BHP walked away, but they had to. They ran out of time in the UK. They got no traction, like I said. It was just an absolute head scratcher. I mean, if it had got up, it would have been the biggest deal of the year by a factor of a few times. And I'm sure at the small of the market, there's been some stinkier deals, James, but this one from such a blue chip company, wow.
Okay. Wow.
Yeah. What's your nomination?
Well, it's not going to be as good after that. That was full Anthony. That was great. My nomination is Perpetual, which did a series of stinky deals, and then sort of culminated this year in the stinkiest of all deals, where it sold itself to KKR, the big private equity firm. Now, I've never seen an outpouring of emotion about a deal like this one, because the Perpetual name, which has been the sort of nursery of fund managers across the country for best part of 2 decades, that name was set to disappear. There was much sort of wailing and gnashing of teeth in the market. What did it say about active management? What did it say about the Australian market? What did it say about Perpetual? Well, what it said about Perpetual is that, again, Australian companies with global ambitions so often get it wrong that it is a red flag that investors need to follow very carefully. The worst thing about this, Anthony, is in the last week or so, we've got news that this tax treatment that the deal hinged on is now going to be disallowed by the tax office. And so the reason for selling to KKR is almost evaporated. Yeah. So now we don't know whether the deal's going to go ahead at all.
It's off.
So it's a mess within a mess within a mess. And a bit like the BHP situation, I think there's a lot more to come in 2025.
Okay, James. Well, we've dealt with the stinkiest deal. What about something a bit more positive? Let's go the Sunny Side Up Award for the feel-good story of the year. I'm
going a little bit back in time and a little bit off Broadway here, Anthony. Back to February 2024, and a iconic name in Australian business, CSR, which sold itself to a French business called Saint-Gobain for $4.3 billion. Now, it's sad to see a big name like CSR disappear from the Australian exchange, but great story here. Very quietly, Julie Coates, who was the CEO at CSR, turned this business around over a number of years, was a bit of a sort of unloved company on the ASX. She quietly came in, started turning around, fixing its supply chain, taking out costs, making the most of its property assets, and then all of a sudden, she's the beneficiary of a big deal from a big French company, which similar to itself has over a century of history, that wanted to get into the Australian market. I think this is, as I say, it's sad when we see one of these takeovers that takes another name off the ASX. But hats off to Julie Coates and the CSR board for getting in, fixing this business, finding a big price from a big buyer and sending shareholders off with plenty in their pockets. Very impressive.
Yeah, the other thing they did, James, they actually got Saint-Gobain on the hook. So they started working with them, distributing a couple of their products a couple of years ago. They got to know each other. Then what do you know? There's this big global player that has a hole in its portfolio down in Australia and New Zealand.
Yeah.
Sure enough.
Yep. Who's your Sunnyside award winner?
Oh, James, I've got to give it to AirTrunk.
Yeah.
The deal that created more than 50 millionaires, a billionaire. It's had two sets of private capital owners that have made 10 times their money. An Australian business expanding into Asia successfully, which is so hard. Company's got relationships with the biggest and most important companies in the world, your Microsofts and Amazon. A $24 billion valuation, talk about getting to $100 billion, hottest sector in the world. And it's done it all in only 9 years, James.
Yeah.
9 years.
What a story.
Get aboard the AirTrunk train. It's just amazing. And James, I like this one because it's not just about one person making money at someone else's expense. It's a genuine new business, new opportunity, growing like a weed. It's not financial trickery. It's not gearing. It's not leverage. I mean, it's hugely capital hungry. Don't get me wrong, and the banks love this thing because there's a lot of loans in there. But this is it's not a tricked up black box. It's a story of a founder who took a punt, was on the bones of his behind, just worked like a dog through it all, and is still going. It was just an amazing story.
Yeah, well said. Exactly. Yeah, we've talked about it a lot on the Chanticleer podcast this year, but with reason, it's good to see it recognised. Okay, the penultimate award is the Easter Egg in Summer Award, Anthony, for the CEO or company that melted under a bit of pressure in 2024.
Got to be Brad Banducci from Woolworths. Poor bloke.
Poor Brad.
I mean, still 10 months on from the incident where he tried to walk away from an on-camera interview on Four Corners. And it's 10 months on, a few months after he's left the building. I still haven't heard anyone say a bad word about the bloke.
Yep.
Colleagues, investors. I mean, even the News Corp guys who had to pap him were telling me how nice he was about it. And this was just a brain meltdown, wasn't it, James?
It was, yeah.
The attempt to walk off mid-interview by Four Corners, our old colleague Angus Grigg, one of the great stirrers. And I mean that with full admiration and respect. I mean, he's a great reporter. It was just a shocker for Brad. And it happened as Brad was probably planning to go anyway, right? He was probably, he'd done his time, 7 years in charge of Woolworths, done the pandemic, he'd had a good run. But it just turned into a messy exit, complete firestorm, and the sort of story that keeps Australian Financial Review in business, James. I mean, this corporate Australia has an uncanny ability just to kick these own goals. And I thought this one was right up there.
Yeah, true.
What's your nomination?
Well, I think we've mentioned a few of the the big stories. I couldn't not mention Richard White at WiseTech.
Oh, yeah.
Look, I mean, talking about own goals, this involved a legal action that White sort of allowed to keep running all the way through to the stages where it got to court and into the public domain. I mean, quite why this dispute wasn't settled well before it got there, I'm not sure. But as it turned out, this opened a Pandora's box of issues in White's personal life, which then spilled into the technology business. I mean, White's done an amazing job of building this business up. It is a genuine global star in quite a specific niche, but it really dominates in that niche. And the shares have still had a good year. and the board have sort of reached a point where they can manage this transition, where he'll shift to a different role, still have lots of involvement in the company, and over time they'll be able to manage, I guess, succession in a better way. But like you said, companies just don't need these own goals. It's hard enough out there, and this was just a series of stuff-ups that the WiseTech shareholders just didn't need to live through. Good
call, James. All right, our final award, the Put a Wing on It award, James, for the CEO or company to watch in 2025.
It's CBA, Commonwealth Bank for me.
Oh, yeah.
We had Matt comment on the podcast last week. He spoke really thoughtfully about how and why his share price has kept running. But this is the big story going into 2025. What happens to the bank shares? Every analyst, every fund manager thinks they shouldn't be that high. But where do they go? What's the catalyst for bank shares to come back? Do they gradually sell off? Do they sort of hold their position while other things in the market go up? I have absolutely no idea, because it's just become impossible to predict where these stocks go. But that is the thing you have to watch. And I'll just throw a sneaky second one in.
Yeah.
Guzmani Gomez. We mentioned this. You picked this time last year, Anthony, as a company to watch. I reckon it's still a company to watch, because again, the stock's exploded since it listed in the middle of the year. It's now trading on a multiple higher than Nvidia's, and selling burritos. I mean, they're very nice burritos, but can that valuation be sustained? I don't know. And to me, that's a sort of, it's a symbol of the bigger story in markets at the moment. Can the valuations of some of these things be sustained? Who are you watching?
Well, GYG, for me, that just missed out on the Sunny Side Up award for the Feel Good Story of the Year.
Yeah.
But who am I watching? Virgin Australia, James. It's gone a bit off the radar, but we've been talking about this IPOing for 2 years now. Now, it missed an opportunity in early 2023. The market was red hot for it, but they just weren't ready. I would say they've missed an opportunity again late this year, James. If you look at Qantas, look at its share price, look at its earnings. It is absolutely raking it in on domestic flights.
Yep.
And that means Virgin will be too.
Yep.
Both of them will be making bucket loads right now. It could have been listing this week. If the time was right for the business, it could have done it. I'm sure of that. But of course, it's been waiting to get this Qatar deal sorted. It's got a new CEO that it needs to announce and come in too. I mean, from all reports, it looks like it was this internal contender, Paul Jones, who's been held up with some pushback from the unions. But the IPO, I mean, it's still the plan for the owner, Bain. And Bain has already made out like bandits on this. It got all its money back and then some more. It'll be making a stack of money at the moment. No doubt it'll take a big dividend just prior to the IPO. It'll get more off Qatar when that deal settles. It's selling a stake, remember, and I'm assured it's at a very healthy multiple. The crowning act from buying a business in administration to listing it, on a big valuation within 5 years or so, will be when it floats.
Yep.
And that still hasn't happened, but it is still on the cards. It needs to happen. We've seen IPOs this year, James. You've got to be a bit different, but they can get away. Now, Bain's going to own, 75 or 80% of this thing. It can afford to structure it a bit differently if it wants to, just to get it listed. It can, if it wants to, it can put out a cheap deal and just list a small part of the company.
Yep.
It could try and do like a GYG or what Sigma did with Chemist Warehouse or the Digico float. It's got options at its disposal, and I imagine there's going to come a time when it'll hit them. So I'm watching Virgin Australia.
Yeah, and it'll be fascinating to see the internals of that business, what Bain's going to take off the table, what some of the executives are going to make. Can't wait for that. Okay, Anthony, we'll come back after the break with our special guest, Emma Fisher, to wrap up a big year in investing. Back in a sec.
Oh, James, that was good fun, but it's time to bring in the big guns. For the final show of the year, we've recruited Emma Fisher, a fund manager from Australian equity shop Airlie Funds here in Sydney. Now, Airlie invests on behalf of retail and institutional clients. It has nearly $8 billion in assets under management. Emma's Airlie Australian Share Fund has returned 11% a year since inception in 2018, while its benchmark ASX 200 accumulation index is up 9.5% a year. Its biggest holdings at the end of November included Ampol, BlueScope, News Corp, ResMed, Seven Group, and a bunch of other well-known companies. Welcome, Emma, to the Chanticleer podcast.
Thank you. Thanks so much, guys, for having me.
Thanks so much for coming on, Emma. This has become a tradition on the Chanticleer podcast that we finish the year with one of the country's great stock pickers. So we're thrilled to have you on board. We've just been through some of our highs and lows for the year, but what's it been like living through all those highs and lows as a professional investor?
Yeah, I always like at the end of the year to sort of reflect on another year of learning in markets. And this has been another really interesting year in a lot of ways. If I had to sort of touch on the big lessons for me or the big themes, the number one story, I guess, of the ASX 200 over the last year has got to be the Aussie banks.
Yeah.
We always like to think that in Australia, we don't have that Mag 7 kind of dynamic that dominates the US index. And we think, thank God we don't have to worry about that. But this year we've had the Magnificent Four, the big four banks. And I think something like nearly half of the return of the ASX 200 this year has come from those four stocks.
Crazy.
So, frankly, as an active fund manager, that's been pretty painful because we don't think that rally has been driven or supported by fundamentals.
Yep.
But, it's happened. So that's been one kind of takeaway or observation for the year. The second one would be stickiness of inflation. A couple of years ago, like the big narrative in markets was this debate between the transitory camp and the structural camp on inflation. And I think reflecting on it, you could probably give the win to both camps. It's been extraordinary, our ability to kind of thread the needle and take the heat out of inflation while not pushing global economies into a recession. But at the same time, that last, you might call it a percent that would get us back in the range is proving very sticky and very hard to eliminate. So I'm interested to watch that story play out next year. And then the third kind of bottom-up stock lesson that's kind of dominated headlines, certainly for the last quarter, has been founders behaving badly.
Yeah.
Obviously you guys at the AFR have been really leading the charge on a lot of this stuff. We own MinRes in the portfolio. But between, and Airlie in general, we've had great success investing in founder-led businesses. And I don't think you want to throw the baby out with the bathwater, but between Chris Ellison and Richard White, there were a couple of weeks there where you felt like an idiot for ever backing a founder. So it's been an interesting year to kind of reflect on that dynamic and learn sometimes where these things can burn you as a shareholder.
Oh, Emma, there's some really big themes there you've given us first up. Just tell us, what's it been like going to work every day where you probably get to the office, you see the SPI futures say the ASX is going higher. You get to the end of the day, the bank shares have gone higher. What's it been like on a personal sort of level? Is it frustrating or is it exciting? Or
look, if you're underweight as we are, it sucks. As an investor, fundamentally, I believe that there has to be a relationship between the valuation of a business, the price you pay for it, and the quality of that business.
Yeah.
So I guess, if you take CBA, for example, which is the best of the big four in terms of quality, and the metric that we use to assess quality for banks is the return on equity that it generates. So CBA generates the highest return of equity of the pack at about 13%. And they only get there by gearing the bejesus out of their return on assets. Like everyone forgets this about banks in the good times, that they are geared assets. But they earn a 13% return of an equity by gearing their balance sheet up. And you're paying 26 times earnings for it today. So I try to be, as frustrating as it is, I suppose, I just try to look at it as dispassionately as possible and say, well, why would I allocate an incremental dollar to that proposition right now when I could buy, any number of stocks? Like ResMed is cheaper, 24 times earnings, return on equity in the 20s, high 20s, probably going to grow double digit for, at the very least for the next 5 years if what they said at their investor day is correct. And that's a true ROE. That's not geared up to the high heavens. CSL, any number of businesses, like the bulk of our portfolio is businesses that are now cheaper than CBA with better returns. So I think that's a really good proposition. So I'm optimistic that that headwind is transitory. But yeah, it's been frustrating, I suppose, when something you feel isn't really driven by fundamentals.
But Emma, we should just explain this because lots of people won't have experienced what it's like to be a professional manager. Really, you've got to stick to the process, right? That's what you're saying.
Absolutely. You have to stick to the process. And my favorite quote in investing, well, probably in life, is one by Martin Luther King, and I'm sure he was talking about a lot more lofty things than whinging about Aussie bank valuations when he said this. But he said the moral arc of the universe is long, but it bends towards justice. And I always think that is such an applicable quote for investing. You know, it may take a long time for, I guess, how do you define justice in this setting? It's for the fundamentals to kind of catch up with the valuation of a business, but it will happen. And every time I've seen in my career, this is why I like investing, because it all compounds. You know, it's like you're watching a bunch of movies and you're watching them play out, and then you realize you've kind of seen this story before. I think they talk about in writing, like there's 7 plots. It's kind of like a little bit like that in investing, and you're like, oh, okay, I've seen this plot before. And whenever in my career I've seen unsustainable things that felt unsustainable in the moment, they are generally not sustained. You know, you saw that 2021 when rates were on the floor and, you know, the free money era, there were a lot of unsustainable valuations that very quickly corrected. And so I guess that's what you take comfort with. And as you say, James, you just stick to the process.
Yeah, Emma, we know exactly what you're talking about, because when Lend-Lease was winding back its global expansion plans earlier this year, James and I went back and we just copied columns from 2000, 2004, 2007 when the same thing had happened.
Yeah, that's one of the plots. Specifically, Lend-Lease having a write-down or something. That's one of the 7 plots.
Don't give away our secrets, Anthony. I also think we should point out that's the first time Martin Luther King has been quoted on the Chanticleer podcast, so you've raised the tone immeasurably, maybe. Emma. One of the things, though, you talk about sort of the arc of justice or sort of, you know, another way of saying reversion to the mean, perhaps. We are heading into 2025 with valuations quite high, both here and in the US particularly, concentration high in the US, and this almost euphoric positive mood around Donald Trump's arrival into the White House in late January. Do you feel any sense of overdone euphoria in Australia?
Yeah. It's a really good question. So, you know, your return in any one year in the market is driven by 3 factors. There's dividends, and that's usually in the order of 4 to 5%. So you can kind of almost bank on that year in, year out at an aggregate level. Then there's earnings per share. So how much do your earnings grow by? And then there's the price to earnings multiple, the PE multiple. And that's really, that's where the psychology kind of comes in, because that's what are investors on aggregate willing to pay for a certain earnings stream. Now, what's been interesting over the last 2 calendar years, is we've had these sort of 20% type returns in the ASX each year. And both of them have been driven primarily by PE. In fact, earnings have gone backwards at an aggregate level in both of those years. So if I was looking at earnings for next year, now a lot of the obviously there's a lot of offshore earners in Australia, but the bulk of the companies listed in Australia are some derivative of a B2C model where they're selling to the Aussie consumer. Yep. And I know that there's a lot of pain out there with interest rates so high, but I guess the positive spin that I'd put on that is that we have worn all of this pain. You know, the market doesn't care about absolutes, you know, good or bad. It cares about rate of change, so better or worse. And if we've worn all of this, you know, I've got a mortgage and I've worn all of that pain as a mortgage holder. What changes now suddenly when we can actually see a rate cut in sight? We can see the end in sight. Yep. What changes now to make everything really gap down in terms of aggregate demand? I can't really see that. I could actually see the opposite, where you do get a rate cut or 2 next year, and people, you know, consumer confidence, which has been in the doldrums for so long, starts to, you know, become a bit more buoyant again. And, you know, potentially we see some earnings growth next year. My base case wouldn't be like off to the races, but, you know, it feels as though we're probably, touch wood, through the worst in terms of just wearing that heavy weight of the incredible rise of the price of money that we've worn over the last few years. So that's the earnings piece of the pie. But the kind of confounding thing is that we're already anticipating it with this great re-rate that we've seen in the market. Yeah. So you could see a world where earnings come back, but share prices fall because they were already pricing that in. You know, I'd say it's not even the banks. If you're a clean kind of quality story right now on the ASX, you've re-rated to, you know, all-time high multiples. Certainly that label kind of fits a lot of the tech companies listed in the ASX. And they're trading as though money's free again. So I think even retail, the humble retailer has had a phenomenal year.
Yeah.
If we had done this podcast a year ago, that probably would have been the part of the market that I would have been calling out as value. And, I probably wouldn't have, in hindsight, picked the banks, but the banks and the retailers have probably reacted on the same thing, which is this recession that everyone was calling for, the fiscal cliff of fixed rate rises rolling off, that just never occurred. And so, the banks have been beneficiaries, the retailers have been beneficiaries. So even though, their earnings may come back next year, potentially we've already gotten the share price re-rate and stocks could be flat or even down. So it's going to be sector specific. Like I'm a glass half full person. There's always ideas out there. But unfortunately, those ideas are going to have hairs on them. Because as I said, if something's obvious and good quality and run by a good management team, right now it's trading very expensive. So, you're going to have to go for some imperfect horses, I suppose, and hope for the best.
That's a nice way to put it. Now, Emma, like in your job and your career, I guess you probably get dealt lessons every year. What was the lesson from this year, do you think, you ought to carry into next year and the rest of your career?
Yeah, look, maybe I'd take it back to that, what I was saying before around founders, just because, so I guess for anyone listening at home, Airlie's process is pretty simple. We start with a balance sheet and then we assess business quality, management quality, and then valuation. Yep. So management quality is basically one of 4 factors that we put a lot of weighting on. Mm-hmm. And we have had really good success and we always like backing founders. But this year, you've had another couple of instances where you can kind of add to your checklist, right? So when you have a mistake or something go wrong, you look for the global lesson in it rather than the specific lesson. So I'm not going to go into my next meeting with a founder and say, hey, by the way, do you have any offshore tax evasion schemes that we don't know about? That's the specific lesson. You've got to look for the global lesson, which I think in this instance is those sort of corporate governance red flags. In particular, I think there's probably one around founder CEOs who are requesting quite excessive levels of pay. If I had to take it back to one of the first maybe red flags in the MinRes story was around, can't even remember the year, maybe 2018, 2019, where they started to get a lot of REM strikes. Now, when a founder who's usually, got the bulk of their wealth tied up in the share price, what's going on in the boardroom where they're demanding these large pay increases when so much of their wealth is tied up in the share price? That might be your first kind of signal. And I can think of a few other instances that I probably won't get into publicly, but a few other instances where you could probably track back the first red flag being excessive CEO remuneration, particularly when it is a founder. But it's not just founders, it's sort of CEOs in general. Where, over the years, I think we've become a lot more stringent on, and maybe the industry as a whole, it feels as though strikes are more common. Voting down remuneration is more common. And it's not that we don't want to see management teams get paid. We don't want equity-like returns without the risk and the reward for shareholders. Anyone who's got a US-dominated business, for example, they comp the US to US CEOs. And then suddenly you're in a whole different ballgame. So, that's one that we really struggle with.
That makes sense.
Okay, Emma, it's crystal ball time. We've got the holidays coming up, but obviously your portfolio trades every day the ASX is open, which is pretty much all of them in the next few weeks. What are the indicators that you're watching out for, or what have you done with your portfolio to make sure it's ready for 2025?
Well, look, we're always, we're such, it sounds really vanilla and boring, I suppose, but we're just such bottom-up investors that really what we're responding to is how things look under our process. And the first 3 factors don't change very quickly. So your financial strength, that's really changing every 6 months with the updated accounts. Business quality, that should be changing very slowly over years and decades, really. Management quality, your assessment there should change as frequently as management, I suppose, which hopefully isn't very often. But the thing that changes very, very quickly is valuation. And I've got no data around this, but I've even felt over my own career that valuation piece is becoming, ever more. These value gaps are very small and they close very quickly. So the way that I guess we account for that is we try to do the work behind the scenes and have these investments kind of ready to go if something should happen. It might be a market meltdown. That most recent example of that would be that March 2020 market meltdown, where suddenly businesses like REA kind of it still looked expensive relative to everything else, but it hit our absolute valuation target and we put it in the fund. We did pretty well out of it and, thought we were geniuses selling it at I don't even know, 120 or something after it re-rated.
It's
gone
twice as much.
Yeah, leaving a bag on the table. But we do own News Corp, which obviously owns 62% of it and has been a good beneficiary of, I guess, the same dynamic. So the way that you ready your portfolio for opportunities is to do the work behind the scenes, meet with the companies, understand the types of businesses that you like, try to put a value on a price at which you think that their value proposition stacks up. And then when these value gaps occur, either through a market-wide sort of shakeout or through something stock-specific, that's probably where we find the bulk of our ideas is just some little hiccup for the individual company. Yep. That's when you get in and you try to determine whether or not it's short-term or not. Again, this time last year, I probably would have been spooking ResMed if I was on this podcast. And it wasn't even their hiccup. It was sort of a market-wide phenomenon where US hedge funds were pretty quick to price in the curing of obesity. And ResMed was perceived as a loser from that because about 70% of their addressable market has sleep apnea that's made worse or more severe by their obesity.
Yep.
So that was an instance where, you like the story, you've followed it for a long time, you're ready to go when that event happens. There's a few, we're always kind of guessing what might be around the corner. So there's a few companies that are on our watch list now where if they have a hiccup in 2025, an event that we can kind of foresee may fall a certain way, then it might end up in the portfolio.
Okay, well, let's dig down on that then. Is there any, you said you would have been spruiking ResMed this time of last year. Who might you be spruiking this time this year?
Oh, so in terms of sort of ideas in the portfolio that I think are good investments from here, I mean, obviously all of them. But if I had to pick some favourites, if I had to give you a really long-term stock, now it's pretty hard to buy here. I'll be the first to admit that. But if you put it on your watch list and got any dips, Sigma, obviously one of the big news stories of the year has been the deal with Chemist Warehouse. We added it to the portfolio and we're able to kind of triage that. The share price wasn't pricing in the full value of that business because of the ACCC risk. So that's when we added it to the portfolio and we didn't foresee the re-rate that it's enjoyed since. But if you think about the long term with that business, I think it's a little bit like buying Bunnings halfway through its rollout in terms of its dominance of its category, the returns that it generates. Okay. It maybe even a little bit better than that because it's actually got legs in its offshore rollout strategy, whereas Bunnings will probably always be just an Australian business now that they've so thoroughly torched capital the only time that they went offshore. So that's one that I think if you could own for the next 20 years and if you could buy it on a dip. News Corp, I mentioned it before. I don't know if it's a dirty word on an AFR podcast.
No, all good, not at all.
I think that the quality business there, the jewel in the crown, is the Dow Jones business, which owns the Wall Street Journal, Barron's, but also some risk and compliance businesses within there that are high margin, growing very quickly, and underpin a lot of the ex-REA valuation. And it's got a good balance sheet. What else? I mean, Ampol's had a really tough year. It seems to just trade on refining margins. I guess the good thing about it here is that it's actually losing money in its refinery this year because it's had outages and refining margins have been so low. So all of the narrative has been around that. Meanwhile, in a normal refining year, 75% of the earnings are non-refining. It's convenience and infrastructure sort of fuel distribution earnings. And those businesses have been trucking along really solidly. Convenience retail has been growing 3 to 4% for as many years basically as the current CEO has been in charge. So I actually think the non-refining part of the business is a really compelling story, and the volatility around refining margins is creating the opportunity to buy this business that will give you a really solid, at the very least, sort of dividend and special dividend kind of capital return piece. And then the upside story is that refining margins do come back. You never know when that happens, but the beauty of the refiner is a few years ago, the Australian government figured out that it's actually a really bad thing for us our global sort of security if we shut down all our local refiners.
Yep.
New Zealand went down that path. And then, if we ever found ourselves in a war, our global sort of fuel supply lanes could be cut off pretty quickly and we'd have 30 days fuel supply. So they want to keep those refiners open, and they did this deal with Ampol and with Viva, who own the other refiner, which was basically to underwrite their losses in the event that global refining margins collapsed.
Yep.
So the way I see it is, the worst you can earn is zero. Now, I know I said before that they're losing money, but that's because of outages. The worst that you can earn from refining margins falling is zero.
Yep.
And you get all the upside, and there's no clawback on that. Now, in terms of the size of the upside, a couple of years ago when, the Ukraine war happened and energy prices went through the roof, the refining business, did over $500 million of earnings. So it's not worth nothing, and it's sort of being valued at nothing in the share price. So that's another one that we like.
Yeah, Emma, if I listen to you talk about stocks there, and when I look through the top 10 that you own, obviously you're a large cap fund manager. A lot of them are going to be Australia's biggest companies, right? Just inherently, that's the way you're set up. CBA, BHP, Macquarie, CSL. But are many stocks coming through the ranks, like coming through the small caps into the large caps, like coming into your universe at the moment, or is it pretty stale and you just you're kicking around the Ampols, News Corps, the ResMeds, like the sort of the well-known ones?
So the way that we report our top 10 holdings is obviously at an absolute level. So it is dominated by the ones that have very large weightings in the index. So the metric that we actually think is a better reflection of where our sort of portfolio bets are, if you will, is our active holdings. And this is, to what degree do we own, if BHP is 10% of the benchmark, if we owned 11% of it, it's a huge absolute weighting in the portfolio, but it actually isn't probably going to dominate our relative returns because it's only a 1% active weight. Mm-hmm. So our large active positions, ResMed, I've talked about that. I think that, the valuation is still very attractive. It's had a great year. It's up over 60%. But what's interesting is, over half of that has come from earnings rather than the PE re-rating. So I still think there's a compelling valuation story there. Medibank, again, I said, if you want value at the moment on the ASX, it's going to have a few hairs on it. Now, Medibank is actually a very well-run business. The hairs on it are obviously the fact that you can't open up the paper without seeing what a dire state our hospital, the private hospital sector is in. So I think that's creating the opportunity. Regulatory risk is an inherent part of the business model. What gives me comfort is the fact that the business is net cash with surplus capital, and it's very well run. It's the largest health insurer in Australia. Yep. And, again, if I had to bring it back to that relativity of CBA, CBA 13% ROE, 26 times earnings. Medibank you can buy for about 17 times earnings, and it does an ROE in the 20s. And an ungeared ROE. So we think a much higher quality business, much cheaper, you get a very good dividend yield, and the opportunity is because, the regulatory debate is so active right now.
Emma, thank you so much. This has been a fascinating discussion. I think it's great to get stock tips, but it's even more fascinating to get inside the mind of an investor and learn a bit about how your process works and philosophy and thinking, and this has just been fascinating for me. I think I've learned a lot about investing just listening to this. So thank you so much for coming on. Do you get a break at Christmas? Do you get to switch off of markets?
Yeah, I do get a break. And I think it's actually really important to take breaks in funds management because, you're always watching the markets. But the kind of seasonal lull at Christmas time, I think it's really important. You're paid to make decisions, and you can't make good decisions if you're burnt out. Although arguably a week in Byron with my 2 young kids might burn me out a bit more than a week at work. So,
well, we wish you all the best for that. And again, thanks so much for coming on.
Thanks so much for having me, guys.
Yeah, thank you, Emma. Good luck next year.
Thank you.
Well, Anthony, that brings us to the end of a fantastic year on the Chanticleer podcast. Recording this podcast each week is one of my highlights, and that's because basically I get to have great fun with a great team. And Anthony, that starts with you, of course, mate. To keep the chicken gags going, you're one of the great wingmen a rooster could hope for. But we've got to say, we sound so good each week because of the brilliant team of producers behind the scenes, Alex Gow and Lap Fan. The podcast is really a team effort. Alex and Lap are not only super audio producers, but they're the heart, soul, and conscience of the podcast. They challenge Anthony and I and occasionally save us from ourselves, which we very much appreciate. Thanks also to executive producer Fiona Buffini, who's been a great supporter of this podcast from day one.
Yeah, James, we'd also like to thank our editors-in-chief, Michael Stutchbury, who's one of the great thinkers on business, economics and politics and had a great 13-year run as editor. We're thrilled he's moving to an editor-at-large role and can't wait to have him back on, especially when things get hot around the federal election. Also, we have to say a big thanks to James Chessel, our new editor-in-chief, who's gone from long-time listener to co-host, where he did a fantastic job. Maybe even too good a job.
Yeah, I did wonder that, Anthony, but I think your job is safe. Finally, our biggest thanks goes to our listeners. We've been blown away by the feedback we've received throughout the year from all quarters, from CEOs and executives, right through to people who aren't living and breathing markets and business every day like we are. We love all your feedback, good and bad, and we particularly love your questions. So keep all of it coming next year. Finally, we wish everyone a Merry Christmas and a good break. We'll be back on February 7 for what promises to be a monster year. Anthony, Merry Christmas, mate, and thanks for a incredible year.
Thank you, James. Merry Christmas to you and your family as well.
If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Anthony McDonald, and our special guest was Emma Fisher. The podcast was produced by Alex Gow and Lap Fan. Our theme is by Alex Gow. The executive producer is Fiona Buffini.
Ho, ho, ho! Merry Christmas!
The Australian Financial Review.